Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers, your go-to source for AI-generated market insights and commentary. We're here to dive into the trends that unfolded yesterday, Wednesday, May 20th, 2026.
That's right, Ethan. Our AI systems churn through an impressive volume of social media discussions and financial data overnight. We saw a lot of activity, flagging quite a few different stocks. The overall market sentiment today, well, it's a real mix. Some promising growth stories, but also a good dose of caution, you know?
Absolutely. Let's kick things off with Nebius Group, NBIS. Now, our analysis shows a mild bullishness on their compute renting business model, which users see as inherently valuable, almost like prime real estate. They just landed a massive $2.6 billion agreement with Bloom Energy, which could be a game changer.
Hold on, Ethan. While that Bloom Energy deal sounds impressive, the KPIs tell a different story right now. NBIS has negative operating margins and extremely thin net profit margins. Plus, insiders have been net selling quite a bit, about 157,000 shares, showing a lack of confidence. And that debt-to-equity ratio at over 131, that's frankly a huge red flag. It's a classic case of future potential versus current performance. My take for NBIS is to stay away.
All right, noted. Next up, International Paper, IP. The social media chatter was pretty quiet, but this one's interesting. While they've shown some serious financial weaknesses, like negative net profit and EPS, insiders have been buying a significant 32% of their total shares. That's a massive vote of confidence. They're also making strategic acquisitions in sustainable packaging, which is a growing market. Yesterday, our AI even had it as a cautious buy.
Ethan, I'm going to have to downgrade that previous rating for IP. Even with the insider buying, the fact remains negative net profit margin, negative EPS, and a very high debt-to-equity ratio of 65.9. Strategic acquisitions are great, but if the core business isn't profitable, those are future bets. You need to see tangible results, not just promises. For IP, it's a stay away.
Fair enough. Let's move to Reddit, RDDT. The community is overwhelmingly bullish on this one, Brooke. Users are calling it extremely cheap for its 70% revenue growth and are talking about it hitting $200 to $300 a share with AI search integration as a major catalyst. Our AI even had it as a stay away just yesterday, but now it's upgraded to a buy.
Well, the numbers do support some of that enthusiasm. That 69% revenue growth is exceptional, and a PE ratio of 1.05 suggests a reasonable valuation for a growth stock. And you know, over 11% of insider holdings were net purchases, which is a strong signal. So while I'm always cautious with social media darlings, the fundamentals here are starting to align with the hype. For RDDT, I'd say buy.
Excellent. Now on to Intel, NTC. There's a lot of chatter about market manipulation and a semiconductor pullback. But you know, they just surged 8% today on acquisition talks and a broader chips rally. Insiders have also been net buyers.
But Ethan, we can't ignore the core financials. Intel is still unprofitable, with negative net profit margins and EPS. That debt-to-equity ratio is extremely high at over 36. And while it's had a good run this year, it's trading near its 52-week high, which, coupled with those fundamentals, means a lot of optimism is already priced in without the profits to back it up. We've largely had a stay-away rating on Intel for a while, and my analysis confirms we should stay away.
All right, let's talk about a real powerhouse, Alphabet, Google. Users see it as a stable liquidity ramp for big money, and the sentiment is leaning bullish. They're making massive AI investments, expanding cloud services, and their revenue growth is a robust 21.8% with an astonishing 37.9% net profit margin. And the insiders agree with you, Ethan, with over 5.8 million net shares purchased. These are solid, profitable numbers for a company of Google's size. That 37.9% net profit margin and 21.8% revenue growth are incredibly strong, supporting its leadership in AI and cloud. The debt-to-equity ratio also looks much better than some of the others we've discussed. Google gets a clear buy from me. Moving on, Rocket Lab, RKLB. It was called a loved stock by some users. Deutsche Bank even raised its price target. There's a lot of buzz around it being a big winner in the space sector.
Loved, perhaps, but I'm looking at the numbers, and they're not loving RKLB. Negative net profit margin, negative EPS, and that debt-to-equity ratio is over 6. And get this, insiders have net sold over 74% of their total shares. That's a huge red flag when the people closest to the company are divesting so heavily despite the external hype. We've had it as stay away or speculative gamble in the past, and it remains a stay away for now.
Okay, let's talk about a new entry, Take-Two Interactive, TTW. The discussion is all about GTA 6, with some users saying it's extremely undervalued and that the hype is not at all priced in. They're anticipating a monumental launch.
Ethan, the hype is massive, I agree, but the financials are currently in the red. We're looking at negative net profit margins and an EPS of negative $22.57. Their price-to-book ratio is a very high 12.5, suggesting a huge amount of future potential is already baked in. And insiders, they've been net selling. While GTA 6 has huge potential to turn these numbers around, you're essentially betting on a single massive future event. For TTW, based on current KPIs, it's a stay away.
Shifting gears to Meta platforms, Meta. The Lizard King himself, Zuckerberg, is making massive AI investments, and users are bullish on their distribution mode. They've got a PE of around 22, which some are calling very cheap for 33% revenue growth and an impressive 32% net profit margin.
I'll concede, Ethan, the fundamentals for Meta are undeniably strong. 33% revenue growth, a 32% net profit margin, and a low debt-to-equity ratio. Those AI investments could really supercharge things. My only slight hesitation is that we did see some insider selling, though it's minor compared to the overall picture. Despite that, the numbers speak for themselves. For Meta, it's a buy.
All right, let's keep the tech train rolling with Microsoft, MSFT. This company is often seen as a liquidity parking lot for big money, and the sentiment is leaning bullish. They're consistently showing strong revenue growth and incredible net profit margins. Plus, the OpenAI partnership continues to be a huge positive.
Microsoft's numbers are consistently solid, Ethan. An 18% revenue growth and almost 40% net profit margin are fantastic for a company of this scale. It's also trading below its 52-week high, which offers some room to run. The slight insider selling is negligible here. With its consistent performance and strategic AI moves, MSFT is a definite buy.
Sticking with the chip makers, Advanced Micro Devices, AMD. There was a social media post suggesting shorting it, but the community shot that down hard, seeing it as fighting the trend. AMD has quadrupled in the last year, with almost 38% revenue growth and massive opportunities in AI.
That 38% revenue growth and its impressive historical performance are very compelling, Ethan. However, that PE ratio is over 149. While insiders are buying, that valuation is incredibly stretched. It implies an enormous amount of future growth is already priced in, making it susceptible to any stumble. My AI also had it as a stay away or cautious buy many times in the past. But given the sustained momentum and AI opportunities, for AMD, it's a buy, but tread carefully.
Okay, next up, AST SpaceMobile, ASTS. It's certainly gaining traction in discussions as a space play, not forgotten like some others. They have big partnerships with AT&T and Verizon backing them, signaling strong industry confidence.
But confidence isn't profit, Ethan. ASTS is highly unprofitable, with a negative EPS of 1.8 and a staggering debt-to-equity ratio of over 112. Plus, insiders have net sold over 18% of their holdings. While the partnerships are future-facing, the current financial risk is immense. We've mostly classified it as stay away or speculative gamble before, and it continues to be a stay away.
And then we have Open Door Technologies, Open. It was flagged as a forgotten stock that no one talks about anymore, implying a bearish sentiment.
And for good reason, Ethan. Their revenue is contracting at 37%. They're unprofitable with a negative net profit margin, and their debt-to-equity ratio is 140. While there's been some insider buying, it doesn't outweigh these severe financial weaknesses. It's consistently been a stay away, and today is no different. A firm stay away for Open.
All right, let's turn to Sellas Life Sciences, SLS. There's huge optimism for their Regal trial readout, with users talking about a potential buyout at $15 to $40 a share. Insiders have actually more than doubled their holdings. This used to be a speculative gamble, but the conviction is strong.
Yes, Ethan, the social sentiment is incredibly bullish, and that insider buying is significant. But let's not forget, this is a binary event biotech stock. It's currently unprofitable, no revenue, high volatility, and that price-to-book ratio is almost 20. If the trial fails, that stock price could evaporate. We had it as a speculative gamble before, but the risks are so immense right now with such a concentrated bet that I'd say it's a stay away for most investors. The upside is huge if it works, but the downside is total loss.
And finally, NVIDIA, NVDA. This is the one everyone's talking about. Despite some user concerns about market concentration, NVDA just crushed Q1 earnings. Revenue growth is an unbelievable 73%, and it has a net profit margin of 55%. Analysts are still bullish, and even with some short-term options warnings, the long-term outlook seems incredibly bright. It's been a buy for us many times.
You know, Ethan, while NVDA's fundamentals are outstanding, that 73% revenue growth and 55% net profit margin are truly exceptional, there is a lot of market anxiety about its sheer dominance. And for short-term speculative plays around earnings, users were correctly pointing out risks like IV crush. Also, that debt-to-equity ratio is high at 7.25. However, the PE ratio below 1, strong Q1 earnings, dividend increases, and significant insider buying for the stock itself cannot be ignored. For the long term, despite market concentration worries, my assessment is buy. Just avoid those short-term option gambles.
What a day, Brooke. Let's wrap up our hunt with today's top candidates for deeper analysis. Investigate as buy. Reddit, RDDT, Alphabet Inc., Google, Meta Platforms Inc., Meta, Microsoft Corporation, MSFT, Advanced Micro Devices Inc., AMD, NVIDIA Corporation, NVDA. Investigate as cautious buy. None. Investigate as speculative gamble. Take-Two Interactive Software Inc., TTW. That's all the time we have for today. Thank you for joining us on the Daily Hunt for Multibaggers. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. From Ethan and myself, Brooke, have a profitable day, and we'll catch you next time on the Daily Hunt for Multibaggers.